optimistic. This has led to a view that Budget 2016 itself may not give the street the impetus to move decisively in either direction. CNBC TV 8's Arundhati Ramanan wraps up the key reactions to Budget 2016.
Prudence lies in adhering to fiscal targets. Consequently, the fiscal target in the revised estimate of 2015-16 and the budget estimate of 2016-17 have been retained at 3.9% and 3.5% of GDP respectively. While doing so, I have ensured that development agenda has not been compromised.
This prudent streak has won the finance minister quite a bit of appreciation from market watchers. While Citi says the assumptions behind the fiscal math appear credible, Bank of America Merrill Lynch says the budget seems to strike a balance between fiscal constraints and growth in select areas amidst an uncertain global environment. And Nomura Sonal Verma begins by saying the government chose macro stability over growth, delivering a positive surprise by sticking to its fiscal consolidation roadmap. But the budget has also raised some questions, especially when it comes to sticking to a tough 3.5% target for FY17. As the Nomura note goes on to point out, we think the fiscal assumptions are optimistic on asset sales but conservative on tax projections. Much of the funding is coming via asset sales, disinvestment, strategic stake sales, telecom spectrum, where market conditions and balance sheet capacity will play a key role, but lower tax assumptions suggest that the overall revenue collections are achievable. However, expenditure on account of the 7th Pay Commission seems to have been under-budgeted, which could lead to higher spending later. Morgan Stanley strikes a similar note. It says some of the negatives include optimistic assumption on non-tax revenue receipts from telecom spectrum options, optimistic assumption on divestment target, partial provision for increased expenditure due to OROP and 7th Pay Commission, and that the 25,000 crore rupees set aside for PSU Bank recapitalization may not be sufficient. UBS, meanwhile, takes a slightly harsher tone. It says the consolidation is of poor quality in our view. More than half the consolidation is due to divestment or telecom spectrum sales. This does not increase the pool of savings for private sector, inhibiting growth. Capital expenditure is budgeted to decline as a share of GDP. The central government stance suggests that the states may also be forced to stick to their fiscal limits, which implies deterioration in their quality of spending too, given CPC-linked increases in pay is a bigger issue for them. Nevertheless, on the whole, brokerages say the budget has thrown out some positives for the market. These include reducing the discretionary powers of tax officers, a scheme to settle disputes and provisions to plug cash transactions to improve India's ease of doing business ranking, the reiteration that GAR will be launched next year, several FPI and FDI limit enhancements, and tax incentives for startups. In addition, brokerages laud Mr. Jaitley's efforts to battle rural distress and his scattered handouts to the small taxpayer. However, they are not happy about the absence of a cut in corporate tax rate, the additional 10% tax on corporate dividend income, an increase in securities transaction tax on options that are not exercised, a hike in the service tax rate to a new set. Given this situation, most brokerages don't see any compulsion for the markets to move sharply in any direction. UBS says, our revised end 2016 Nifty target is 7,500. Our downside scenario implies a Nifty value of 6,500. The budget is unlikely to alter market trajectory though, and global risk environment should drive markets near term. Morgan Stanley suggests that any up move may be driven more by bargain hunting than the budget itself. It says the market appears to have support from poor sentiment and reasonable absolute valuations. Also keep in mind that the month before budget has witnessed the second largest fall in the market pre-budget going back 25 years, underscoring the point on sentiment. Similarly, Bank of America Merrill Lynch says market focus should soon move on to earnings delivery and global cues, with fears of punitive taxation behind it. Citi agrees, saying the budget, lacks growth impulses, is unlikely to, in itself, spur economic or market momentum, and the equity market will need a more bottom-up earnings growth uptick to respond to what should be a stable top-down India. Maintain positive view on India with a 27,200 December 2016 Sensex target. Of course, a lot of this up move will depend on how soon the RBI makes use of the government's fiscal discipline to cut rates, and by how much. While all brokerages agree that the budget opens the door for the RBI to walk through, Nomura expects a 25 basis point repo rate cut in April with a greater chance of an intermeeting cut. UBS expects a 50 basis point cut in policy rates in 2016 instead of the earlier expected 25 basis point cut, and Morgan Stanley maintains its call of one rate cut at the April meeting. However, Morgan Stanley caveats this by pointing out that the RBI may move with caution, as it may want to wait and see what effect the 7th Pay Commission recommendations and OROP payouts have on inflation. In Mumbai, Arundhati Ramanan.